Hi, everybody, and welcome to this live CNBC.com special Sunday report. We appreciate you taking a little time with us on this busy Sunday. I am Brian Sullivan, and we are live here on CNBC.com because we are coming off not only a tumultuous week where you saw interest rates spike, we've had a violent weekend, although thankfully was not as bad as it could have been. And now there are a lot of questions about what's going to happen with energy, with interest rates, with the Fed, with defense, with technology, all next week as well. We got a full lineup of CNBC regulars and reporters, as well as special guest Jenny Harrington as well to try to make sense of it. We'll be live with you here for about 20 minutes. So thank you very much for joining us, folks. And let's start here. Let's start with the weekend. Now, the United States saying it will not participate in any other retaliation that Israel may undertake in response to the attacks, 300 plus projectiles over the weekend. Thankfully, 99% of those were indeed neutralized. Every report, everybody we're talking to says the ball and really geopolitical risk is now in Israel's court to see what they, if anything, do to retaliate against Iran. But we've got inflation running hot as well. We've got the Federal Reserve potentially maybe not in play at all this year. So let's start there and bring in senior economics reporter Steve Leisman. Steve, obviously, we're waiting on things to open up, waiting to see what oil does. But any more inflationary shocks certainly could put the Federal Reserve back on notice, I would imagine.
Yeah, it would be another reason, Brian, for the Fed to hold rates right where they are right now. And a lot depends, as you said earlier, on Israel's response here. If this remains where it is right now, and I am looking at futures just modestly opening higher, I think it's important, Brian, to take a step back and think about how we closed on Friday. I thought we closed very much with a flight to safety, it wasn't a pure flight to safety, but you saw bond yields were down a bit. You saw the dollar was stronger and stocks were lower. It was kind of like a classic flight to safety. It may be, we'll see, we'll watch the futures trade if there's a bit of a sigh of relief here. And I know that you're going to watch oil, and we're going to talk about that in just a minute. But that could be a major route that this affects both the U.S. economy and the Fed. Another surge higher in oil prices would make the Fed very wary of cutting interest rates into that environment. If you think about the Fed in absence of this issue or the danger of higher oil prices, I think where you get is a much more dovish outlook, the possibility that they still could cut. You had Morgan Stanley over the weekend. They went from June to July, but a lot of people are not writing it off. There's a pretty a dovish case I think you could make that the Fed still has a cut or two in it this year, and that should not be completely written off. But a lot depends, Brian, I think, on this issue here when it comes to how Israel responds. If this is it, we can start talking about normal fundamentals.
Does Jay Powell and the Fed care about why a price is higher, Steve, or only that the price is higher? Because if oil goes over 90 or 95 because this continues to escalate, Jay Powell, smart guy, knows there's not much he can do about the geopolitical risk premium.
I think that's an excellent way to look at it, Brian. And I think the why prices are higher is going to be a key to the Fed's view of it and how they respond, because the why could tell you how long, right? The Fed would not change its outlook if you're talking about some kind of short-term blip that would happen as the price of oil that would not feed into essentially higher oil prices, higher energy prices, and then into higher consumer prices. But if this looks like it's a longer haul with higher oil prices, then I think the Fed would be concerned. I think it would also be concerned if what you're seeing in oil is kind of like the leading edge, essentially, of a hotter economy that would lead to more inflation. So the why matters a lot to the Fed because the how long matters a lot.
Yeah, and this is a terrible metaphor, but if we did get an oil and or natural gas spike, certainly vis-a-vis gasoline as well, it could pour that proverbial fuel on the inflationary fire, could it not, Steve? Because inflation is already we've seen these last couple of months with a sort of a reversal, a little bit of tick back higher. We always think about just driving. Oil, petroleum products, chemicals, natural gas, they go into over half the products that we simply consume and manufacture every day. I would imagine that a spike in the energy complex would not be, let's call it, a welcome outcome for a Fed that's already probably getting a little nervous about inflation rising again.
I think that's 100% right. I also think that, there's a couple things here. One is that the Fed in general would look through an oil spike if it didn't sort of bleed into other areas of the economy. But the thing the Fed would be concerned about is a long-term spike in oil, a long-term spike in inflation that affected inflation expectations and made people think, hey, A, the Fed is not serious. B, we should act and buy and consume at a perceived higher inflation rate than the Fed's target. That's something that would concern it enormously. And you're right about the impact of oil prices. And what we learned, Brian, I think, is that oil prices have a much bigger impact than previously thought when it comes to not just the price of energy and commodities, but the American psyche.
All right, Steve, sit tight there as well. Going to bring another known voice into this conversation. That is our friend Bob Pisani. Bob, of course, will be live at the New York Stock Exchange with the open on Monday morning. But, Bob, obviously the weekend, luckily 99% of these projectiles were indeed, preemptively hit. They did not detonate. It could have been much, much worse. I wouldn't be surprised to see a bit of a sigh of relief. What are you most closely watching on Monday? Is it the reaction to this, or is it what we just talked about with the Fed? Is it earnings? Is it something else?
Well, we've got a very complicated stew here, which is one of the reasons the market had such a strange reaction on Friday. I agree with Steve's point. Ultimately, it's about flight to safety. But if you watch the behavior of oil, of gold, of even the 10-year interest rates, they were all over the place, indicating that people were rather confused about what was going on and what the trend should be. So we have this complicated stew, sticky inflation, geopolitical concerns, and a little disappointment on bank earnings, on Friday. So to me, the way I look at this is there some catalyst for a deeper pullback? We're 2% off of the highs at this point. So what would cause a decline of, say, 10% or more in the market? And traditionally, you have several things that have that happen. Number one is you would traditionally have some kind of concern about the economic outlook, particularly jobs turning down and the earnings situation deteriorating rapidly. We're not having that right now, at least not yet. Another concern would be some kind of exogenous shock. The Arab oil embargo, COVID, a war. And unfortunately, yes, the risk is definitely elevated here of some kind of geopolitical shock. The third thing that would cause some notable decline historically would be some kind of rapid rise in interest rates. And Brian, you don't have to have this coming from the Federal Reserve raising rates and making a policy mistake. You could have a series of really poor Treasury auctions or debt downgrades. There's a lot of risk out there. Remember, and Steve knows more than I do about this, I think the government's trying to raise $10 trillion this year. This is a lot of money, and a lot of things can go wrong with that. So that's kind of what I'm looking for. But Brian, you're the energy guy here. The markets are opening here slightly higher. Oil is down a little bit. The market seems to be saying not as bad as feared in terms of what happened with Iran. I don't know. I'm curious about your take on this.
Yeah, and I was posting this on X on Friday night. I was speaking to some senior high-level intelligence officials, some of them inside and around the White House, about the various scenarios. And I posted kind of the three scenarios out there, which is, one, Iran does nothing. We knew that wouldn't happen. Two, they do something that is easily, or not easily, but is able to be, intercepted prior to causing damage. And then number three, the all-in worst-case scenario. Scenario two appears to be what we got. I don't want to get into the geopolitics and speculation. Other people can do that, guys, better than I can. But I'll say this. One thing that I was told by a senior intelligence official on Friday was that Iran effectively gave the U.S. time before attacking Israel to move more defenses into the area. And to them, that was a clear sign that Iran did not want to escalate any further, do something so big that it would force Israel to respond in kind or worse and rope the U.S. in. I only bring that up, not as a geopolitical expert, but because, guys, what I've been told, Bob, and again, we're starting to get the trades now. To your point, we're starting to see oil tick down just a touch and futures tick up just a touch. I think, Bob, that you'll hear tomorrow, and I'm going to kick it right back to you because we're just unscripted. Let's have some fun, which is that this is a market that didn't get the shock and awe, thank God, by the way, that it was worried about.
Yeah. So now, for my point of view, we're going to have earnings this week coming big. We had a little disappointment on Friday with some of the banks. You don't see J.P. Morgan down 6% very often, folks. That is a J.P. Morgan is what we call a low beta stock. It doesn't move much. When the market moves, it pretty much moves in relation to the market. And that was a really outsized move there. Some concerns about lower net interest income that's out there. So that'll be an issue. But overall, earnings are holding up really well. And in fact, Brian, you cover this. Energy stuff has been spectacular recently. The energy is the second biggest return so far on the year. And unfortunately, as you know, it's unloved and underowned rather dramatically. So people are sort of chasing returns at this point with the technology stocks not performing quite as much and energy materials and industrials doing a little bit better. But to me, that's a sign of market strength. So nothing's changing the earnings narrative yet. But because of geopolitics and because of interest rates, it's a delicate situation. Steve?
Brian, I just wanted to jump in. I mean, we have to be very careful here about signaling an all clear, especially when it comes to the Middle East. There's actually two things to think about. One is you do have to kind of game out and speculate on possible potential responses, whether or not there is indeed an all clear. The other problem is, and Brian, I think as somebody who's covered oil, you can appreciate this. It's how news comes out of the Middle East, and it doesn't come out exactly with a bow tied around it and precisely as clear as we would sometimes like, which means that there is event risk, there's headline risk, and I'm not quite sure how we get exactly around that over time. Perhaps a statement by Israel that would say we are not going to respond, although I think it would be unusual for Israel to ever say such a thing, which means that, right now the market can be trading a little bit higher as a sigh of relief. You could have some folks come in tomorrow morning and say, you know what, there's headline risk out there, and that makes me want to be a little less long the market here.
Yeah, excellent point, Steve, because, and I think this is, for everybody out there watching and listening right now, that is a very, very important lesson or thing to have in the back of your mind. Israel doesn't do anything for the next couple of days. We go back to focusing on earnings and interest rates and the Federal Reserve. And then one night you wake up because they're, 8-9 hours ahead or 6 hours ahead. And you wake up and you find out that Israel decided to take out Iran's nuclear facilities in the middle of the night without any warning. And I think that's a market where, Steve and Bob, jump in, please. You could probably agree that we see massive moves in rates, energy, and stocks. That headline risk has got to be there until Israel says, we're done as well, I think.
Yeah,
yes,
I mean, I'll let Bob talk in a second, but I'm a little bit outside my area of expertise. That's not something they would do, and we do know historically Israel has wanted to address the threat from Iran. They wanted to do so with the United States, so that's just historical fact. But I don't know. Now is an interesting time to be listening to perhaps sober Middle East experts.
Yeah, that would seem to be a fairly disproportionate response. But I think the key point here is when you're dealing with probabilities, up until recently, geopolitical risks outside of Russia, Ukraine going much wider was fairly low. They're now much more elevated. And if you look at the world, the way I look at it, what's the probability of a serious decline in the stock market? What would cause that? The three things are decline in U.S. economy, particularly jobs, not happening, geopolitical risk increasing rapidly, that's there, and interest rate risk that's out there. Those are the three things. The two of the three are higher probabilities now than they have been recently. And so, yes, I think there is elevated risk, although what you were saying about that response from Israel seems a little bit disproportionate to me, but who knows?
Well, we'll see. Yeah, well, but in 2008, Israel pressed the U.S. to help them do that, and then President Bush turned that down, thought that it would just be too much at the time. So it's been out there before. We'll see what happens. Again, just throwing it to Steve's point that the risk is not gone, but let's bring in an actual investor who can talk about sort of how to manage this. That is our friend, CNBC contributor Jenny Harrington of Gilman Hill Advisors as well. By the way, guys, futures really not moving at all. Oil's down 12 cents, kind of the market staying static. Jenny, welcome. Thanks for taking or spending, investing, whatever you want to call it, some of your Sunday, a busy Sunday in the 6 o'clock hour here on the East Coast. What is your take on the markets near term, and how closely are you watching, of course, all the geopolitical risk in addition to inflation and the Fed and earnings?
Well, obviously, from a personal standpoint, from like human emotion, you've got to watch what's going on, and it's really taxing, and it takes a toll on people. What I think is interesting is I love the way Bob Pisani called it a complicated stew, and that's what we've got. And even if you take the Middle East out, it is still a very complicated stew. And so as a portfolio manager, I'm really struggling with this idea of the market trading at 21 times earnings, because 21 times earnings is representative of a lovely, perfect backdrop. The last time the market traded at 21 times or above that was early 2022 and 1999, 2000. So that is a rich multiple that suggests sunshine and roses ahead. And so we've got this struggle of the complicated stew, the persistent inflation, divisive and contentious election coming up, high valuations, tax cuts expiring in 2 years, budget deficits booming. And you take that and then you juxtapose it with, you know what? Earnings are growing, and they are likely to hit that 12% growth target this year. And interest rates, they are likely to come down still. And so with the second half of that, you can justify the market here. With the first half, it's tough. So as a portfolio manager, what I think we do right now is presume the best we get out of this year is probably 11%. We all know one thing is guaranteed. Market's never flat. So I think there's going to be a lot of volatility between here and the end of the year. And with that, if you're a long-term investor, you grit your teeth, bear it, don't be stupid, and act emotionally because you know your timing will be bad getting out, timing will be bad getting in. As a trader, take advantage of it. But it's tough right now. I mean, it is emotionally very, very difficult right now to figure out how to proceed.
It's yeah, Jenny, you're right. I mean, obviously, this is a scary time for everybody in the world. It's not the stuff that we want to deal with. Thankfully, the defense has worked. I mean, it's just we need peace, not more war. That said, we're dealt the hand that we're given, and that's how we have to manage this. Is this kind of a market almost, Jenny, where I don't know if you're going energy or not, but can you just go to, you know what? I'm just going to buy NVIDIA. I'm going to buy Amazon. I'm going to buy Google, Alphabet, because they're not going to be theoretically impacted by anything that's going on.
I think that's true and not true, but I think you need to be really careful about what multiple you pay for everything, because when people feel bad, I think the biggest risk to the market is multiple contraction, and that takes everything with it. So the higher and the frothier the multiple, the worse the fallout is. So I love our energy positions. We have companies like a bunch of the midstream companies like ONEOK, Williams, Kinder Morgan, Energy Transfer Partners. Love those. Overseas, we have Total and Shell. I love owning those. Here we also have Pioneer. So all of those I feel very good, very comfortable about. I would never want to sell them. On the tech side, our tech exposure is a little lower multiple. So Cisco, DocuSign, yes, we own Meta, yes, we own Uber, Skyworks. All of these have a better, in my opinion, a better valuation given what the growth prospects are than some of the top 10 or Mag 7s. So even within the Mag 7, you've got to be careful. You've got to differentiate. It's not just about the story right now.
Brian,
the valuation really matters.
Brian, just real quick to Jenny's point, there's a history of these things, and there's conflagrations like this. There was the Iran-Iraq war. I mean, there was the Iraq war in the U.S. There was 9/11. Markets sell off, and markets come back relatively quickly from these things. The only thing, I think only Pisani on this panel is old enough to remember this, which was the Arab oil embargo in 1973. That was a big upset to the market. And in fact, Bob is not that much older than I am, but I remember it too. And the point is that most of these things engender a sell-off. And the reason they engender a sell-off, I think, is the lack of clarity as to potential outcomes. Outcomes become pretty clear pretty quickly. And usually in a matter of days, weeks, or a short number of months, the market comes back.
Jenny's bringing up a very important point, which is I'll make one quick
Bob.
point. Jenny's got a very important point. The distinction between an earnings contraction and a multiple contraction. In an earnings contraction, the actual numbers, the estimates come down. In a multiple contraction, a multiple is simply what is the market willing to pay for a future stream of earnings revenues. How much of are they willing to pay for that? Right now, it's 21 times forward earnings for the S&P 500. If earnings estimates could stay the same, the actual numbers could stay the same, but if the market isn't willing to pay more for that, the multiple will come down and the stock market will have to come down, even if the earnings numbers don't come down. And sometimes people have a hard time understanding that. And Jenny, thank you for making that distinction. Yeah. We could have a multiple contraction where it goes from 20, whatever it is now, 20.1 to 18, and the S&P will come down, even if the earnings don't, if the market comes to believe that, for example, higher interest rates are going to dramatically impact the earnings situation, even if the numbers aren't changing right now. So thank you, Jenny, for that distinction.
Well said. And by the way, in the shorter term, I would add that in 2020, we took out Iranian General Qasem Soleimani, and Iran responded by sending a bunch of missiles at U.S. air bases inside of Iraq. Luckily, the market sold briefly by then, but we know that it's well above that point since that time. Jenny, I want to take it back to you. Is this, though, then a market that is priced in many ways to perfection, that this geopolitical risk is certainly imperfect, right? There's an unknown here, and if we're trading at multiples that are near or at all-time highs, to me, that says this market is at risk in some ways.
Right. And this is where it gets really complicated too, because when you talk about this market, you're talking about the S&P 500. And we all know that there's a lot of bifurcation between the S&P and what else is going on, which I really struggled last week with why I personally felt so miserable with the market being down about the market, S&P being down about 2%. I mean, who cares, right? It was up 11% for the year. Now it's up 9%. That should still be great. But the problem is that everything else isn't up that much. So you have international up about 3.5% on the year. You have small cap down. Bonds, the 20-year bonds are down 8% on the year. And Barclays aggregate bond index down 2.8. So once the markets, once the S&P starts leading the way and things trade off, you're not only up 9% on the year. Any mortal human being who isn't 100% in the S&P, you're actually down on the year. And so as we shift out and as we move around with that 21 times, it's going to apply differently to different segments of the market. Theoretically, things that have a lower multiple should be insulated, at least in the long run. That didn't happen last week. So I think, to me, one of the hardest things to figure out right now is sentiment. The market's just a reflection of how people feel. And we cannot forget that if you feel crummy, you don't go to dinner, you don't spend as much, you don't pay 21 times for earnings. So to your point, Brian, that 21 times is a reflection of perfection, at least at the S&P level, but we know that everything else follows it. So it's a tough time now.
And you said earnings, so let's pivot to that as well, because obviously the weekend was a scary time, the geopolitical risk, everything that just happened, but let's not also forget that we're now heading into earnings season. Technology, the big dog in earnings, Deirdre Bosa joining us as well. And what do you think the market, what are you, Deirdre Bosa, most closely watching coming up this week? Because this is the next 2 weeks is gigantic for earnings.
It absolutely is. And you've got tech, right, kicking it off. And tech has just led the way for so much of the last year and a bit that they have to perform to really underpin the market. You've got the Magnificent Seven just making up more and more. And I think when the last few weeks you've seen more volatility, some of the wind comes out of that AI trade that has been so powerful in 2023. So it's not as much of a focal point for markets. But at the end of the day, the mega cap companies, and this is where maybe I disagree a little bit with Jenny, they're almost safety plays, right? Because they've got stellar balance sheets. They've got low debt levels. They've got wide moats. They're industry leaders, just really, really strong fundamentals. So when you see volatility, tech doesn't get hit as hard necessarily the mega cap, right? There's kind of mega cap and everyone else, the unprofitable names, they're going to be the first to sell, especially if you've got higher for longer rates. But you've got the mega caps really just underpinning the rally. And you've kind of still seen that. The NASDAQ is still outperforming the Dow, the S&P this year and over the last month. This week, speaking of earnings, you've got Taiwan Semi and Netflix, but then the week after you've got Apple and the mega cap start to report. So they're going to have to continue to show those strong fundamentals if they're going to underpin the markets.
Yeah, you wonder if they'll just be, as I kind of intimated to earlier, just that haven view trade. Let's also bring in another voice, somebody freshly back from Colorado Springs at a big space and defense symposium. That, of course, is Morgan Brennan, who covers defense and anchors the 4 p.m. Eastern Time show. Morgan, 10 years ago, Lockheed Martin was a $100 stock. Today, Lockheed Martin is a $450 stock. It's gone from $100 to $450 in just 10 years. Whatever the fear and the emotion around this weekend and where we go from here was, it's clear that investors have been paying a lot of attention and spending a lot of money on defense companies.
It's a great point, Brian, and certainly that's going to be in focus with markets this week, and perhaps it creates a sentiment shift around the defense stocks, which, Lockheed Martin has surged over 10 years, but over the past year or so, not necessarily been the case for many of these big defense contractors. First, I have to go back because I've been working the phones all weekend. I've spoken to more than a dozen current and former defense and intelligence and national security and state officials, as well as geopolitical analysts, as well as Middle East experts. And I just want to add a little more context that I think is really important for investors around this attack, these attacks that we saw from Iran this weekend. And then I'll get into the defense piece of this. The first thing I'll just say is that Iran gave Israel and the U.S. and allies 10 days to prepare and for communications to happen. The U.S. actually back-channeled through Switzerland with Iran during that time as well. So to your point about how this choreography played out and how these counterstrikes from Iran into Israel played out, there was a lot of time and there was a lot of messaging and a lot of choreography that went into this. That being said, when you're talking about 300 missiles and drones, you're talking about the upper end of what I think military and defense officials here in the U.S. were anticipating. So it was still a very forceful attack. And yes, while missile defenses were almost overall completely successful in this process, putting names like RTX and Lockheed Martin and Northrop Grumman and General Dynamics in focus for investors as well in terms of some of those capabilities and the success and now increasing demand of those capabilities. This is the piece to watch for investors this week and over coming days. This is what some national security and defense officials said to me today. The big question is not only whether, but what Israel might choose to do in response to Iran. Since this attack was unprecedented, Iran sending all of these missiles, all of these drones into towards Israel out of Iran, not just out of its proxies, but that the U.S. does not envision itself participating in a counteroffensive. So we will have to see how all of this plays out. Not going to speculate on that. But one of the things to watch for defense investors this week is going to be whether that supplemental bill, whether it includes broader Ukraine or is just parsed out into $14 billion for Israel, actually comes back to the floor in Congress and actually makes its way through Congress, which would increase the defense budget here in the U.S. and thus orders for the defense contractors.
Yeah, and I want to start to wrap it up. I want to. That's excellent all around and great color working the phones. I want to have a little bit of news myself on the energy complex and then give everybody a final word. There was a report out, I think it was Friday, that the White House is ready to enact some new rule changes in Alaska and the Arctic Wildlife Reserve that would limit a huge swath of the area to oil drilling and or make it uneconomic. The industry is preparing for that. I want to give a little news that people I talk to that are close to the situation have said that that rule change may not happen or may be delayed because the last thing the White House wants to do now, given everything that's going on in the Middle East, is to seem like they're taking actions that could actually hurt U.S. production and potentially raise oil prices even more. So there's a report out. I can report that report may be premature or not happen because we don't want Steve Leisman, I don't think $5 a gallon gas, not just in California, heading into the summer. And the Federal Reserve is going to be looking at it.
No, and let's just be clear, Brian, that the price of gasoline is not the most important issue when it comes to thinking about war and those sorts of things. I know that's what we focus on, and it's probably the right thing to focus on as the most important issue that would affect markets and the economy. But I also think it's important to recognize that what's happening now is happening in a context of a very, very different U.S. energy industry. The price of oil, I would imagine, Brian, and you probably have a thought on that, in a context where the U.S. production was half of what it is right now, would be substantially higher. The impact on the U.S. would also be substantially worse. We are the largest producer. We are, in ways that we have never been, dramatically insulated from oil price spikes that would have far less impact right now than they would have in the past. The impact on inflation is dramatic when you think about it, that the Fed is trying to get to 2 and they're at 3 and we might go to 4. But it's not 3 going to 7, 8, 9, or 10. It delays going to 2. So putting our problems in context, I think, helps make a little more sense of just how concerned to be about something like this.
Bob, most important thing to you tomorrow morning, come opening bell time?
Well, I would agree with Steve. 50 years ago, almost exactly, the Arab oil embargo, what happened was the U.S. was so dependent on foreign oil at that time that it literally was a major factor in tanking the U.S. economy and causing inflation for years to come. It was a major problem. That kind of thing is not going to happen now. It's not that it wouldn't impact us, but as Steve points out, 11 million barrels a day we produce. We are the biggest producer in the world, perhaps neck and neck with the Saudis right now. And that's a major change in things. I am concerned about geopolitics. I'm concerned about higher interest rates. But the U.S. economy right now is still really strong. And that's why we're only 2% off a new 52-week high on the S&P 500. I don't see that changing immediately. But then again, this is a very complicated stew that we've got. Tomorrow, I think we're going to have a little bit of a quiet open and a relief rebound. And arguably we ought to, based on what we're seeing now.
Yeah, we're producing more oil than any country in the history of the world. And let's not forget, OPEC also has 6 million barrels of spare capacity. If things got really bad, might be able to convince some of the OPEC members to put a little more oil on the market. That aside, Deirdre Bosa, technology. What are you watching most closely come tomorrow morning?
And earnings as a whole, right? There is a lot riding on them. But of course, the tech names are just taking up so much of the market over the last few years. Their weighting is so heavy. If they stumble, the broader markets are going to stumble. The mega caps have just such a pulse on the consumer, whether that be Apple's iPhone and services business to Amazon's e-commerce. And then you got to watch the hyperscalers. That's Amazon, Microsoft, and Google, because they have their pulse on how the enterprise is feeling, the kind of enterprise spend, and also, of course, all importantly, the AI trade, right? They're the gauge of how much companies are spending right now. So that is going to, be important for market resilience with everything else going on.
Deirdre Bosa, Bob Pisani, Jenny Harrington, Morgan Brennan, Steve Leisman, and everybody at CNBC behind the scenes as well, working on a Sunday night to bring us this live, CNBC.live special report, given everything that's going on. Everybody, thank you for taking time out of your Sunday. Let you get back to your families and your friends. Everybody, thank you. Just a quick note, by the way, folks, go to CNBC.com/pro. If you haven't signed up, be sure to sign up. There's a lot of valuable content on there, actionable information in these sort of nervous times. Michael Santoli is going to have a new column up as well. So get a chance. Always check out CNBC.com/pro as well, folks. We will see you at 5 o'clock Eastern tomorrow morning for Worldwide Exchange with the markets. Futures right now, by the way, are not moving very much. Oil is not moving very much, as it does appear, at least for now, that the markets and the energy markets are breathing a little bit of a sigh of relief. That's a nice way to leave it and a nice way to end it on a beautiful Sunday here on the East Coast. Thank you very much for tuning in, everybody. We'll see you 5 o'clock tomorrow morning for Worldwide Exchange.